Hi everyone, and welcome to the week in review. It's Friday, 14th of October. Some people used to call this Uptober, but I don't know if we can this month. Nonetheless, it's been a busy few days, and yeah, we've got a lot to get through. Another major hack, 9 figures worth, following last week's BNB chain incident. So this time, something in the Solana ecosystem. We'll go into that. More developments with the SEC, chasing Yuga Labs now, creator of the Bored Ape Yacht Club, rather than Kim Kardashian from a few days ago. Lots of gas being burnt on Ethereum, and inflation is also coming in hot. So lots to get through. To kick us off, Tom, could you go into detail what's going on with Mango markets and yeah, what happened to the exploit and the person behind it?
Okay, so what happened to Mango is that on I can't remember if it was Wednesday or Tuesday, but like Mango Markets, which is a decentralized futures exchange on Solana and quite a popular, like it's one of the only Solana apps that like people actually like. It was exploited for about $100 million. So there's quite a lot of stuff to unpack around the exploit. First off, it's not a hack. Like the code was not like there was no vulnerability in the code or anything like that. It was actually a trader. Well, it's through a trade that like the money was drained from the treasury. What happened is that a trader took a huge, I mean, like a very big like position relative to Mango's like liquidity. What he did was that he took a big position in Mango perps, so Mango futures, and this inflated the price of the Mango token by I think it was like 5 times, 3 or 5 times or something like that. So like this happened because like the liquidity on Mango like is like very small. So like I think the size of the position was about $10 million. So a $10 million size, a $10 million position inflated the price of Mango, and because the price of Mango was so up, the traders um the size of the traders like the size of the trader's position itself like increased, so he was able to like borrow a huge amount of tokens from a huge sum from the treasury. He borrowed like I think he borrowed up to like 110 million or 100 million. I'm not quite sure. And then closed his positions, but essentially he drained the liquidity from the Mango protocol because his position was artificially like inflated. So after that, he's like the trader started like sending the exploiter, the attacker started sending some of his gains through Circle, and the trail kind of like may have picked up on Ethereum from that side. The other thing that happened was that he used some of his Mango tokens to make a proposal to essentially like make a proposal in the Mango governance forum to absolve him of any wrongdoing, and he'd reimburse the protocol and the users and everything like that, but only if Mango gave him, I think it was like $70 million or something like that from the treasury. Like essentially like Mango protocol itself would be like destroyed. He still gets away with it, and but the users are made whole. And kind of funny is that he voted like he used some of his own tokens to vote for a proposal and like bumped it up like he like a third of the tokens necessary for a proposal to pass were like furnished by him or them or her, I don't really know. So that's kind of like what happened on Solana. Then there's like an independent investigative reporter found evidence suggesting that maybe the person responsible for this was a trader by the name of Abraham Eisenberg, who like So the journalist found this out because Eisenberg had talked about exploiting a similar, like a protocol, a lending protocol, in a similar fashion in a private Discord server, like 6 days before the Mango hack happened. Um, so like the journalist provided like screenshots of the conversation and everything like this, and like a lot of the details surrounding the exploit are like very, very similar to what like Eisenberg was talking about. And there's also on-chain evidence suggesting that a wallet that could be connected to Eisenberg um, may, like an Ethereum wallet connected to Eisenberg, may have received 3 transactions for like USDC transactions, like within a minute of these USD, like of very similar funds being sent to USDC to Circle from Solana. So it kind of suggests that like if Eisenberg did it, if that wallet is responsible, what happened is that the exploiter sent I think it was $30 million through Circle, and a minute later, like from Solana to Circle, and a minute later from Circle to Ethereum, and then change those tokens immediately from USDC to DAI, probably in order to avoid getting blacklisted or censored or something like that. So I think that's a pretty good picture of what we know so far. Like, did I miss anything, Christian?
Cool. Yeah. Thanks, Tom. Yeah, like you said, lots to unpack here. Um, yeah, this was interesting because usually when we hear stories like this, of like lots of money that gets lost, it's usually a result of like yeah, buggy code and like an actual hack. Whereas yeah, in this instance, it was more like seems like the person was able to do this because they were a whale in the first place, and so they had this collateral, and then kind of yeah, obviously dabbled in Mango's futures contracts, and yeah, sort of like you know, took advantage of an opportunity there. It's actually led some to say like, oh, maybe they weren't you know, maybe they did nothing wrong. That's probably a controversial take, some would say, but yeah, it's super interesting. And I found the response that they gave in the DAO, where they basically said, "Oh yeah, you guys can commit 70 million from your treasury, and as long as I kind of get away with this and there are no criminal repercussions." They're just kind of, I guess you could call it like DeFi theater. It's just the kind of thing a lot of people are commenting on this. Just shows how crazy crypto can be. And yeah, there are probably a lot of people who say it kind of holds the space back when this stuff happens, and you can see why, right? Yeah, I followed the case as well, so I saw you know, the name of the guy who's been accused and this kind of thing. I'm not sure if I can give a conclusive take of myself on who I think is responsible, but yeah, lots lots kind of taken, and another massive incident that we've seen. Yeah, Tom, you mentioned the Cosmos case earlier. What's the link with Cosmos here? Could you explain that as well?
So yeah, Mango. It's funny, like both. So like last week there was a big hack on BNB chain. Someone exploited a vulnerability in the blockchain's. I think it was the blockchain's bridge, and managed to siphon $560 million from it. And once they had that, essentially like wreaked havoc in, like, not didn't wreak havoc, but like they did a bunch of like really weird like on-chain activity with it. We discussed this last week. The 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 curious thing is that BNB chain used the Cosmos SDK like infrastructure in order to like build itself. Like like technically BNB chain is an IBC blockchain, which means that it could be connected to the Cosmos ecosystem. So when the exploit happened for BNB chain, Cosmos developers started looking into it to see if, especially because it had to do with its bridges, to see if the vulnerability was something that could be found in other IBC blockchains. And it turns out it is. And yesterday, Ethan Buckman, who's the creator of Cosmos, maybe co-founder of Cosmos, posted an announcement in the Cosmos Hub forum, explaining that essentially every single one of the IBC-enabled blockchains in the Cosmos ecosystem, so that's 42 different blockchains totaling $8.18 billion in value. Every single one of those blockchains had the same vulnerability that allowed the hacker to siphon funds from BNB chain. So the Cosmos and Osmosis teams have been patching up all the major, helping to patch up all the major chains. They've already privately communicated to all the teams in the Cosmos chain, in the Cosmos ecosystem. But yesterday's announcement was kind of like a call for everyone to, I think it's today, in a few hours, there will be a public patch that will be made available, and all the validators are highly encouraged to put through that patch to essentially mitigate that vulnerability. So the link with Mango is that both of these exploits, like the Mango exploit and the BNB exploit, are quite and consequently the IBC stuff, they're quite different, but they're similar in the sense that these are quite sophisticated attacks, and not just there was a really obvious error in the code or something like that. We've had a lot of different kinds of hacks in the past few months. I think these are the two most interesting cases, even if it's for different reasons. For Mango, it was a trading opportunity. Some people, I saw the same people. I saw people say it's not really a hack; it's an arbitrage opportunity. Like the guy just used, I mean, the attacker just used the protocol in a way to he put up 10 million in order to extract 100 million. That's a really successful trade. So that's an arbitrage opportunity. On the BNB chain side, it looks like it was an extremely complex vulnerability that was exploited, and a vulnerability that may have been around from the get-go in the Cosmos ecosystem and for years, and no one even realized it. So yeah, I find both cases really interesting.
Yeah, thanks, Tom. Yeah, lots there. Lots of value lost or potentially lost as well. I think in a newsletter that Tim has written that's going out later today, he said that it's something like 700 million or already this month. Correct me if I'm wrong, Tim. 718 million over the past 7 days. I mean, it does kind of feel at times in this space like we can't go a few days without another one of these massive kind of thefts, hacks, exploits, whichever way you see it, trading opportunities, as some would say, coming to light, and lots of money getting lost, users getting burnt, and then a team having to rush to fix things and potentially suffering massive reputational damage. I mean, is crypto ever going to kind of evolve if we just have this thing sort of happening all the time? And how do we kind of get past this? Do you have any thoughts on this, Tim?
That's a very good question. Initially, yeah, I mean, I think this is something that isn't, it's not something that people worry about so much when crypto is kind of under the radar. It doesn't have the kind of mass adoption that we're all hoping for in the future eventually. So, even when there's just stupidly large hacks, like you mentioned, like 718 million over the first half of October, the people who are getting hacked are, like you say, ultimately the users, if they're providing liquidity, or the VCs are the ones who pick up the slack, who have backed projects. That was the case in the wormhole bridge hack that happened earlier in the year. Jump Capital, I think, paid the bill there. But once big companies get involved, I'm thinking, like PayPal, Visa, if that eventually happens, I think there will be some very, very important questions asked. Like they're not going to allow this to happen, or even the possibility of it to happen. So yeah, like, what are the answers? Bridges will probably see less use, or there will be some kind of centralized bridge where all transactions are, verified, much in the same way there is in traditional finance. I could see that being an option for a lot of companies where it's sort of like half blockchain, half centralized. Other than that, I think it's interesting that a lot of hacks that exploit the code are EVM chains. I haven't looked into this, but it's interesting how Tom said that the same exploit that hit BNB chain was there for anyone to exploit, and perhaps still is, on Cosmos and their whole ecosystem built on the Cosmos SDK. But there are far fewer people who know how to like properly code, like on Cosmos, than there are people who know Solidity for Ethereum. So I think that actually limits the amount of like danger those chains are in, even if there is some shoddy code there. There's just fewer people who actually know what they're doing and know how to like code on those blockchains in that sort of ecosystem. But that's not going to be that. It's not going to be that way forever, because especially if you're a Cosmos bull, you're going to be hoping that there's more adoption, and eventually, it's whatever gets popular. People are going to be looking for exploits there. So yeah, long term, I think bridges are going to have to see some kind of like technological improvement in terms of security, or they're going to have to switch over to some like quasi centralized solution. Because if the institutions are coming, and they're not going to stand for this. They're not going to put up with it.
Yeah, thanks, Tim. I mean, I remember we used to say about this time last year, I mean, because this was kind of when things were hitting a top, that Solana kind of had a moat because it was Rust rather than what is Rust rather than Solidity, and there were just like kind of no hacks happening there, where versus on Ethereum, where it seems to happen every week or so, or BNB chain often as well, and often there were kind of rug pulls and this kind of thing over there. I mean, this is the $1 million question kind of thing. It's like, what is the sort of future going to be in terms of like avoiding these things happening, and how kind of users going to be protected in the future? Do you have any thoughts on this, Nivesh? And where do you see things heading? Do you think we'll see less of these kind of incidents if we look 5-10 years out?
Probably yes, because we'd have developed more, and there would be more security measures, as Tim pointed out. But yeah, like if I would just continue from the last point that Tim brought up, is it's like whenever something starts becoming popular, it's probably because its TVL is growing, usage is growing, so that becomes a honeypot for the hackers. And I think this is one of the reasons why they went with BNB, because where else would you find 100 million sitting in a protocol? So if there, like, come the next bull market, there will be new protocols, new bridges, and there will be new sorts of hacks. But if there is money coming into the system, then bad actors would also play a role. But it only makes us stronger, and it has for since I at least started looking at it. We don't hear about exchange hacks anymore, which was like a pretty big thing before this bull run. And I think even blockchains are pretty much secure, like the independent ones. But bridges are a big pain point. So IBC is another bridge implementation to connect blockchains, and it was supposed to be one of the best solutions and one of the most secure solutions that could enable like interconnections outside of the Cosmos ecosystem as well. But I'm pretty much disappointed that it's finding vulnerabilities, but I hope they can fix it. Otherwise, yeah, the whole ecosystem where the whole yeah, the point where we can have an ecosystem of multi-chain and we can interact without, like, users can interact without much hassle and the experience is good. uh, we have a lot of work to do to reach that point, and there will be a lot of hacks along the way. But I see that future planning out, so it will happen, but not without a few roadblocks.
Thanks, Umesh. Yeah, a few roadblocks. Yeah, I mean, these kind of incidents kind of feels like a sort of, yeah, reminder and a reality check in a way of, like, kind of, it's a meme, but how early we are. I remember last year when prices were peaking and everything was soaring, there was this idea, this narrative that crypto had gone mainstream and it was kind of, that was it now. We'd crossed the chasm. But when these things happen, it's like, oh wait, actually, yeah, there is, like, still a really long way to go before, we are sort of ready for mass adoption. Yeah, just to close on hacks and this kind of thing, I think it's worth sort of discussing, yeah, some of the things that sort of listeners and the crypto users can do to protect themselves. I know I think about this a lot. I'm probably more conservative than most in that I tend to avoid, like, DeFi and smart contracts where possible. Most of, like, my holdings I keep on cold storage, and I actually had a realization a week or so ago where I'd bought, like, quite an expensive NFT and it was kind of sitting on my MetaMask for about a week, and then I kind of just thought one day, because I saw a big hack happen, and I was like, what am I doing, kind of thing. And then, like, yeah, ended up moving it over to a vault. But yeah, Tom, do you have any tips on how people can sort of protect themselves other than the obvious, like watching out for links and, yeah, using cold storage, hardware wallets where possible? What about those who are looking at DeFi and all that kind of stuff, staking?
Yeah, like I'm also quite a conservative DeFi user. But I do love to interact with protocols. I think for the majority of people, it is very hard to just see exactly what you're signing for when you're signing onto transactions and everything. Everyone's like, oh, you need to make sure you're not actually allowing a protocol to exploit you or something. I think you've got to just progress, knowing that you don't necessarily know what's going on. So I just go on the basis that I'm an idiot and that I could get exploited. So I try to interact with when I interact with protocols that are quite new or quite niche, I make sure to do them with clean wallets that don't hold a lot of tokens. Um, I'm very careful about where I keep the bulk of my crypto. Like hardware storage is obviously everyone will hardware wallets are great. I think centralized exchanges, like the major ones like FTX, Coinbase, Kraken, Binance, these are also quite safe because they've got a huge amount of liquidity. I would not keep really any of my tokens, like any of my coins, on any other exchange. I tend to just think that this is kind of if I tend to try to keep my interactions with protocols to a minimum and spend some time really trying to understand the protocol. And once you've figured out a way that works, I kind of just try to stick to it. Just small practical things like this that don't necessarily have to do a lot with knowing a lot about the blockchain, but like it's kind of like the same kind of like common sense behavior you would have, for example, like if you were traveling to a city you don't know or something like that. Like you know, you arrive somewhere and like you don't really know the lay of the land. You just take some precautions. Like you don't go out with like loads of watches at your wrists and like, you know, like gold hanging from your like neck or anything like that. Like those are kind of like the base. Usually if you take like common sense approaches to like security, it tends to work out quite well. So that's usually what I'd recommend for people.
Cool. Yeah. Thanks, Tom. Great. So yeah, I mean, I just mentioned NFTs and that kind of thing. Our next story sort of relates to NFTs and also crime or purported crime. It's one of the US's government agencies, the one who's kind of probably been most active in monitoring crypto this year. So the Securities and Exchange Commission came out with a fresh update this week in that it is reportedly looking into Yuga Labs, the creator of Bored Ape Yacht Club, to assess whether, as far as I understand it, whether Bored Ape NFTs and the other airdrops they ran, and possibly ApeCoin as well, whether they constituted unregistered securities, which would sort of be illegal given that they weren't, they hadn't kind of signed up with the SEC. Tim, what's going on here and what's it mean for NFTs?
Yeah, thanks, Christian. So, yeah, it's just another classic case of the SEC's sort of ongoing campaign of regulation through enforcement. It's a probe into Yuga Labs, specifically, I think the document says in regards to the original Bored Ape Yacht Club NFT collection that kind of put NFTs on the map back in, was it May last year? But also, and I think this is the interesting part, the ApeCoin token, which was launched earlier this year, and it was distributed in an airdrop to Bored Ape and Mutant Ape holders, as well as a bunch of it was given out to so the key contributors to the DAO who were going to lead it. So yeah, where to begin? From the Bored Ape Yacht Club NFT side of it, I really don't think there's much case there. I think that they've just put it in the probe as sort of a pretext to try and get to ApeCoin, which is the part that I think they're really going for. Now I remember when ApeCoin was launched, though I read through the website, it was quite big news at the time, and they had consulted some top lawyers when they put this together. They knew exactly what they could and couldn't say. They were making all the correct disclosures, making sure that anyone who went to the ApeCoin and then subsequently ApeDAO websites would know that this is not affiliated with the incorporated entity Yuga Labs. This is completely decentralized, not related to them. In order to avoid liability, because they could see the writing on the wall. They could obviously see this coming, like most people, and they didn't want to get hit by an SEC probe like what's happened to them. So my assessment is that the SEC don't really have a case against ApeCoin. It seems to me that there's some kind of like knuckleheads at the SEC who are going around and just seeing what they can like go for. They probably don't understand the crypto space very well. They probably didn't consult the documentation on ApeCoin and the ApeCoin DAO. No, I say this not because I'm like underestimating people at the SEC, but they've previously done similar things where they've brought probes against protocols or DAOs or whatever. And it just, from the outset, it looks like they don't really have a case, but nonetheless, they try anyway. So yeah, I guess we'll see what happens to it. I imagine the probe won't really go anywhere. I can't really see an in for them unless they come out with something interesting that I don't anticipate, which of course could happen. I didn't anticipate them going after Ethereum transactions all being conducted in the US in the Ian Bellina case the other week. So they can surprise, but from the outset, it really doesn't look like they have much of a case. what does it mean for NFTs more generally? Well, the SEC is clearly watching them, and there are definitely projects out there that have issued tokens in a more, reckless way that the SEC could probably, pick apart and definitely win a case against. I don't think that Yuga Labs and ApeCoin is one of them, but there clearly are those out there. So, if you're thinking of picking up some NFTs, might want to do some research there to make sure that they're not vulnerable, because the SEC is looking into this stuff and you never know who is next.
Thanks, Tim. Yeah, I think you've summed it up pretty well. I mean, when we talk about Yuga Labs and Bored Ape Yacht Club, it's kind of something we've said over the course of the year. Everyone has their opinions on like the artwork and stuff, and maybe some people think the community is lame, but it's very hard to fault Yuga Labs on their execution. It's like they kind of just did everything right for a long time, and everything was really well thought out, and it was kind of like they set the template for other projects in the sort of avatar domain to follow. And yeah, I remember when ApeCoin launched, like you said, it was massive news, and it was like such a big payout for the holders as well. It was like if you had one of those Bored Apes, which was already up massively off the mint price, like hundreds of $1,000s at the time, and then you got this distribution of ApeCoin that was like over $100,000. And yeah, this was around the time that they raised from A16Z as well. So they're very well funded, and it's like they're not like a clown outfit like a lot of these NFT projects are. So clearly they have like legals and this kind of thing, and are thinking about these things. So then that raises the question of like, yeah, are the SEC going to succeed with Yuga Labs, or are they just kind of doing this for show? To me, it feels like a lot of it is for show, because they went after Kim Kardashian as well, who's one of the most followed Instagram users in the world. It just kind of feels like they're maybe going after the big names to sort of make a statement. That's how I kind of see it. Tom, you're unmuted. What's your take on this?
I see the link between like Bored Apes and Kim Kardashian as like similar targets, but I actually think this is more like when the SEC went against Ripple, because Ripple turned out to be like a quite formidable enemy like against the SEC, because Ripple is well funded and they can get really good legal counsel and everything like this. And I think even though like you can say whatever you want about Ripple and XRP itself, the fact that they're really well funded and they can like have like a legal case that spans years and everything like that, they can fund that, they can like defend themselves and everything. I think it showed. I think like first off, like it like the SEC kind of just shot himself in the foot with that. But I think this is maybe what it like made the SEC start targeting like ICO projects with like that have like much less funding, that like have much less of a good case like going for them. Like they've been targeting like very like small forgotten projects like, I don't know, Dragon Chain and like those other 9 projects that like they said were listed on Coinbase and everything. And I think that's been quite smart of them, because it would be easier for them to score wins on that side than against like a big enemy. And like by targeting Bored Apes, I think they're kind of like forgetting that lesson, and they might just like end up with another like long lawsuit that doesn't like turn out in their favor. So I don't know. I think like I didn't think of them as knuckleheads, but I think Tim's assessment's not completely. There's a lot to it.
Yeah, thanks, Tom. Yeah, I mean, to me, it's like this isn't the first SEC story we've seen, even this month, and yeah, I mean, I find it hard not to be kind of like suspicious of what they're doing. I've kind of probably ranted a bit too much about this on these calls in the past, but it's like kind of feels, yeah, not just the Kim Kardashian thing, but there was like the thing Tim mentioned with the jurisdiction over Ethereum transactions, where it kind of felt like it was just something that they hid in this lawsuit against an ICO case, maybe to sort of set precedent for something. And yeah, now they're kind of sort of maybe going after ApeCoin, which is an ERC20 token in a similar way. But yeah, Nivesh, what's your take on this? What do you think the SEC is up to, and what do you think the implications could be for the NFT space as a whole?
Actually, I've always thought that the SEC has a legit case against like NFTs and the companies that are dropping NFTs because, uh, like with Yuga Labs, the holders expect a lot from the company, and they had other drops associated to the main NFT collection. And I think this is also something which people look forward to, and obviously coming from Yuga Labs. So there's a lot of dependence on a single entity, and that's how I see the implementation of securities law in it. But yeah, obviously, Yuga Labs is capable of handling a big case, and they surely spend a lot uh, towards their legal budget, and I think they can drag the case for long. But I think that there might be something to it. The SEC might gain some advantage from the courts, where maybe it sets a precedent for new projects, and even if they settle outside the code, or they are just written off with a small fine, it can have implications for the future. So that is something I'll be looking forward to. And obviously, like the holders of these NFTs right now, and not all of them bought during the mint or when the price was low. So some of them uh, paid a lot of money to get that, and there's a lot of nervousness. I expect that is growing amongst them. So uh, yeah, it like even for a small time, if it shakes out the market, which is pretty nascent, if you look at it, it's only been a year that NFTs have taken off, then it can be something to look out for. We cannot be like not cautious at this point of time, because there's a lot of money in some of these collections, and uh, the SEC won't be like I. It's fine. Like they might be shooting in the dark, but they still have some. They still should have some ground that can cause harm to the space.
Cool. Yeah, thanks for that, Nivesh. Mitchell, I haven't heard from you yet. I'd love to get your thoughts on some of this, and specifically around NFTs and NFT collecting. What do you think are kind of ways to sort of navigate this space safely and potentially avoid the risks of stuff like, a project turning into security and this kind of thing? Um,
I mean, we've talked about this quite a bit. We've known that some sort of securities action was probably coming for NFTs eventually. And the reason for that is clear. Like the way that people use NFTs as a vehicle for financing their operations and for starting these new projects has been evident during this last NFT cycle. And I think that it's reasonable that the SEC wants to set some sort of precedent where it can have some oversight over that market. So that much makes sense. In terms of how to stay safe for the collections that you're individually investing in being deemed unregistered securities offering, I think for now, you're probably safe with smaller projects because they have bigger fish to fry. And that's part of the reason why I suspect they went after Yuga Labs, is by targeting one of the biggest and well-known NFT projects, they can set a precedent that they have quite a bit of control over this particular segment. Now, for smaller projects, I don't think that there might be some retroactive action down the line, like Dragon Chain style, but it's probably years in the making. So for now, so long as you have like a medium-term horizon, for most projects, you're probably fine. Not a lawyer, but that's my opinion.
Cool. Yeah. Thanks, Mitchell. And yeah, do you see a difference with the classic ERC20s? Because we're talking about ApeCoin here, and then the Bored Ape NFTs as well, and yeah, potential implications for NFTs in the long run. What about the kind of fungible assets that a lot of us hold?
I mean, fungible assets have always had like securities concerns around them. Like the SEC has been very clear around that most tokens are probably considered securities and under the purview of the Securities Exchange Commission. So I don't think much has changed in that regard.
Cool. Yeah. Thanks, Mitchell. Yeah. Fair. Lots to think about there. So yeah, from one thing that's kind of dominated a lot of the news on Ethereum over the past year and ended up burning a lot of gas, to another now. This new project that emerged, I think was Sunday, and sort of took off on Ethereum, ended up burning quite a lot of gas and was quite like a hyped event while it was going on. I think the hype has slightly fizzled now, but worth looking into nonetheless. So this is a Zen Crypto. I don't know much about it, but I think Nivesh, you were following this quite closely. Why was this something that people were talking about so much? And yeah, what was happening with Zen?
Yeah, I hope that I followed it closely enough, but actually I missed it. So yeah, on Saturday, I think an ex-Google developer like just uh, made this contract where you could mint tokens for free. Not exactly free because you still had to pay gas fee. And yeah, so the amount of tokens that you could mint depends on the number of days that you want to vest your tokens for, and how early you were in getting to the mint contract. So naturally, it was like a free money for everyone who came in early. So they just went for one day, and they would get around, I guess, in the beginning, it was around $2,000 for like the first few who minted, the first few addresses who minted. And there was obviously Sybil attack on it. People started using multiple addresses. Then more sophisticated users would have used bots, and you could have like hundred or even thousands of addresses minting this coin, and then claiming it the next day to sell it off. So yeah, this mania took off, and it primarily took off because the Hex crowd, the Hex cryptocurrency, has been around for some years, and I think in their socials, this broke first, and they have been a large crowd for some time, and eventually when this free money Ponzi took off, then everybody started jumping in, and what it led to was clogging the Ethereum network, and that's how it became a mainstream news, where around half of Ethereum's network was being used to like mint these free tokens or to trade these tokens. And so I think on Monday, for the entire day, this was like it was consistently above 40, like the usage of this contract was consistently above 40%. And eventually, when a lot of people got in on the hype and they started selling, then it faded. But yeah, it was like an interesting 2 days. If you were relatively early to it, then you could have made at least a couple of $1,000. So it 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 was a momentary thing. So I would say that if it's like we were talking about security a while ago, so it's not safe to just interact with any freemium contract that comes along your way. So in these sort of things, I would obviously look, like I'm not an expert with smart contracts, so I would look for like some devs that I have like marked on Twitter or some Discord groups, and see what the experts think there in terms of how safe the contract is. And so yeah, only use it with a wallet which has not a lot of money in it. But it's not good to miss out on these opportunities as well. So yeah, because it can give you a lot in a very short amount of time. Another thing that I want to mention about this is that the fact that it took up half of Ethereum is a sign that we are at the peak of a bear market, where a simple Ponzi Freeman scheme is taking up a lot of the network, and uh, not the other activities that we'd expect to happen, such as DeFi and more like authentic NFT sales, like maybe from big brands and stuff, and more games being played and such. So yeah, it's like, and the gas fees again, like increased again because of it. So it's like you get a deja vu that okay, things are still small, things are still developing, and you might get an opportunity here and there to earn. And so yeah, be safe when you're going about doing that.
Thanks, Nivesh. Yeah, I remember this breaking at the weekend, and I did see some people kind of talking about stuff, and then I got a message off a friend, and they were kind of like, "Oh, what do you think of this?" And I was pretty busy at the time. I think I was like doing groceries or something, and I didn't click the link, but I just replied rug risk, meaning that I considered it outside of my sort of comfort zone to sort of go to a website and connect to Web3 and sort of try to mint this thing. So maybe that's just me being cautious, but yeah, like you say, there are definitely opportunities like this, and in a way they're maybe easier to spot in a sort of downtrend when there's just less noise and less going on, because it does feel like there are things like this that launch every week or so in the bull market. But yeah, I want to touch on the point you raised about yeah, gas guzzling. That it does feel like, yeah, this happens on Ethereum quite often, where you get these things where something emerges. I mean, last year it was all about NFTs, and OpenSea was taking up all the gas, and now it's kind of this thing, maybe pointing just less activity happening elsewhere. And you see a lot of like Ethereum people celebrating it when all the gas gets burnt. Um, yeah, like what do you make of this, and do you think it points to anything in particular, and to do with like scalability as well? I mean, we've seen enough of these kind of clogs, and it can get pretty pricey to use the chain. Do you think that like are they going to solve these issues eventually, or are we just going to have to deal with this for the next few years until they bring in shard chains? Or
Yeah, I think like uh, the necessity for shard chains uh, might be huge, and we don't realize it yet, because uh, but we have had like a lot made we have made a lot of progress with layer twos, and I think a lot of the DeFi stuff has moved to Arbitrum and Optimism, and a lot of people are using it as well. So I'm not sure how, when the load on layer 2 increases, then like it borrows some kind of security from the mainnet. So maybe when that starts increasing a lot, then what kind of an effect we are going to have in terms of the gas? Like, will layer 2 need to increase their gas, and will it become like practically impossible to use the mainnet if you're not doing it for large transactions? That is something that I want to that I want to see play out. Otherwise, yeah, I mean, most of the activity is on Ethereum and stuff like that, but these things keep reminding us that uh, it's still not capable to support like the financial system of the world, and basically no blockchain is at the time. Solana like marketed itself as the Nasdaq for crypto, but we see it's not perfect by any uh, like dimension or sort. So it's just the fight that it continues, and I don't think I have much to say, because yeah, it's like it's we'll go back to the blockchain dilemma, and we'll talk about security, scalability, and decentralization and this sort of thing. But I think the main point with Ethereum is how like the increased usage of layer 2 affects its gas, and should like I hope that it's able to solve most of the issues that we faced at least last year. So it is able to support DeFi cheaply, and cheaply enough, and then NFTs as well, so that we can think of other applications that might come down the line. And if that goes smoothly, then yeah, we don't need sharding immediately. But if that starts to become a problem, then it's definitely something to look out for and to be cautious about.
Thanks, Invesh. So yeah, it sounds like yeah, look to layer 2 and yeah, see how that develops. Yeah, I mean, wait, what you say about kind of the high gas guzzling, showing that we're in the depths of a bear market as well. Just to slightly divert, I've kind of felt like sentiment is at a low since Ethereum actually did the merge last month, in that it does just feel like that was kind of the last narrative, and since then it's like the kind of reality of the macroeconomic picture and just the bearish vibe that you get across the space. And when you scroll your feed, it does feel like that a bit to me. And when we talk about this, we had news this week of inflation coming in higher than expected, so 8.2%. And then crypto reacted by doing another like mini drop down. I know you were watching this, Tim, and yeah, sort of we collaborated on a story on this. Were you surprised by the drop, and yeah, what do you think it means moving forward?
Yeah, I wasn't really surprised by the drop. I mean, 8.1 expected, 8.2 actual year over year in CPI. So, it's 10 basis points off the expectation. But the reaction, I think, was interesting. That was the surprising part. So yeah, the figures came out. We immediately like plummeted down like 4% on Bitcoin, 6 for Ethereum. And then I think a lot of people probably saw that and then like shorted or like doubled down on their shorts, thinking that this is like the final leg down to like 12K or wherever anyone's personal predictions might be. But then yeah, some huge buyers stepped in to defend like the 18,000 level for Bitcoin. It didn't surpass the June lows. It came back up, and then all the shorts got liquidated, and we've had this like what turned into like a dip event. It just went a U-turn straight back up, like in a whipsaw action. And yeah, and I think people did not really anticipate it. Something similar happened. I saw someone discussing earlier in, I think, the August, so it would have been the July CPI numbers, where it initially went down and then came back up as the market didn't really make up its mind. So yeah, the reaction is strange. I think a lot of the time people try and like retroactively fit narratives to try and explain what's going on. Like if job figures come out and they're really bad, and then everyone's like, oh, well, bad news is good news because it means the Fed will have to pivot. But then the next event comes out and it's like, oh, CPI is still high. It shows that inflation is sticky. And now we've gone up off that. And how do you explain that? I mean, I guess then now the narrative becomes, oh, well, central banks are under a massive amount of stress, and that's good for, assets like crypto to have a finite amount because, if loss of trust in central banks, increases, then everyone will want to buy Bitcoin because it's the only like solid asset you can easily get your hands on. So, disregarding all of that, I guess my current thinking is like, we're like, we're kind of at the bottom right now. There's not much interest, and really the only thing that matters is liquidity. And everyone who's going to have sold crypto, I think, has already sold at this point. It's looking, I think, as time goes on, it's looking less and less likely that that like 18,000 level on Bitcoin is gonna, I guess we should call it the June lows, is gonna get broken to the downside. And I thought that there was going to be another leg down, but it just time and time again it gets defended. So it's kind of a paradox. Unfortunately, Nathan's not here to comment on this more. I know his newsletter today went into depth about this and how things were looking surprisingly bullish in the immediate situation. But yeah, it's going to be real interesting going forward because I think everyone's exhausted because you see on crypto Twitter a lot. 1 week people are all bullish, and then the next week the same people have flipped bearish, and everyone's confused. The amount of leverage in the systems like hit all-time highs. Like, and I know Nathan talked about this as well. He attributed that to like people getting impatient because we've had such narrow trading ranges and low volatility. The people, traders, are like maxing up on their leverage to try and like get a good trade because they're getting bored. So yeah, I I don't know what else to add, but it's been a weird one, and I would say I would just caution people of whenever these events happen and there's some like change in the market's direction, people always try and attribute retroactively some reason, and I would be careful of that because I feel like it's just people like creating narratives, after the fact instead of something that sounds plausible or fits instead of something that's actually grounded in reality. I think the reality of the situation is like, I don't know. I don't think anyone knows at this point. We're in uncharted territory. The central banks are trying to unwind, over a decade of like low interest rates, and yeah, no one knows really what's going to happen. Maybe, I don't know, maybe some people have some ideas, but I'm, I was playing RuneScape during my free time last time something like this happened, so I don't have much context.
Thanks, Tim. Yeah, hark back to the 2008 crisis. Yeah, it's slightly different this time around, but does feel kind of like we're going through a similar motion again. Yeah, hopefully not as severe. Yeah, I mean, it is interesting. Like, we have seen these supposed bad news events, like the 75-point hike in, I think it was July, like you said, where it was like prices just rallied as a result. Because it was like, oh, well, it's not as bad, and we kind of expected it. So, like, yeah, we'll just buy. And then, yeah, like today, it's like BTC and ETH are both up, and the rest of the market is up as well, after like the dip yesterday. So yeah, like Tim says, it's super hard to predict anything. And yeah, it does just feel like these events. I think the main takeaway for me is that this idea that like crypto is uncorrelated or like moves on its own, that like doesn't exist anymore. Like we are very closely tied to things like central banks moves, what the Fed does, dollar index, all these things that are like also experiencing volatility and unprecedented changes this year. And the idea that like maybe central bank like trust in that can be lost. That's what like Stanley Druckenmiller spoke about last month, and we saw Portia Jones come out this week with similar comments. I kind of believe in that, and I want to believe in that, but I think that's a long-term thing as well. And yeah, for now, I would say that I agree. It just sort of like depends on what happens with the Fed and these other things, and so it's super choppy and it's like hard to navigate. And yeah, we've been caught in this range. I don't know. Tim thinks the June bottom is the bottom. I'm not sure. I don't have a crystal ball, but yeah, that's kind of my take on it. Like sit tight, and I think we can get through it, but it might be a while until new highs for sure. Cool. We're kind of on the hour now, so did anyone have any comments before we wrap up, guys? All right then. So, oh, did you unmute, Mitchell?
I was just going to wish everyone a good weekend.
Yeah, cool. Yeah, thanks everyone for listening. It's been fun. So yeah, just to recap on everything, we had the Mango Market saga and other hacks happening across the crypto ecosystem. SEC going after Yuga Labs and potentially the broader NFT space. Lots of gas burning on Ethereum thanks to Zen Crypto, and high inflation numbers and volatile crypto market. I think that covers it. Thanks everyone for listening, and yeah, we'll be back next week. Have a great weekend.